Our speaker today is Eric Zwick. He is an associate professor of finance at the University of Chicago Booth School of Business. Eric studies the interactions between public policy and corporate behavior with a focus on fiscal stimulus, taxation, and housing policy. His research draws on insights from finance, behavioral economics, and other areas of economics. He tends to use new data, natural experiments, theory, and even relies occasionally on anecdotes. And you'll hear about one of his projects today. He earned a PhD and a MA in business economics from Harvard and a BA in economics and math with high honors from Swarthmore. Prior to grad school, he worked as a web and software developer for several startups and nonprofits. In college, he played lead guitar in a very mediocre rock band called Paul and the Bond Squad. After college, he played in a slightly better band called the Horse Latitudes. He has the lowest golf handicap of anybody on the Booth faculty, and he claims he taught Larry Summers a good deal of what Larry knows about golf. So, I will give you Eric.
Timer here. Okay, thanks so much, Anil, for that thorough introduction, which I guess I'm responsible for since I wrote all that. All right, so I'm very happy and excited to be here today presenting sort of a synthesis of a few papers, a line of research that I've been working on for the last 4 or 5 years, which focus on top income inequality. The title of this talk, which merges a few papers, Top Income Inequality from the Bottom Up. The idea here is that there's a lot of focus on this group at the top of the income distribution, and we're using data, micro data at the individual level that we then sort of aggregate up, but we really focus on kind of the granular patterns underneath these like macroeconomic statistics, trying to understand stuff, learn new lessons about what's going on in the data to inform policy better. Okay, so to motivate this talk, there will be very few equations, by the way, so don't worry. There will be mostly pictures of data. This is the most famous graph in economics in the last 20 years. This is the time series of the top 1% share of income in the United States, going back to the beginning of actually the income tax system, which this data relies on income tax data to measure the income of the top 1%. This shows the top 1% in black, and then some groups within the top 1%, the 1 to 0.1, the 0.1 to 0.01, 0.01, to give folks a sense of what that means in 2014 dollars. To be in the top 1% required having a salary or a total income for tax purposes of $400,000. To be in the top 0.1%, $1.5 million. The top 0.01%, $6.8 million. So that's the income flow to give you a sense of what these folks are earning. And this could be either an individual person or a couple that's filing taxes as a household. So the story here is that top inequality was very high in the early part of the 20th century. It fell mid-century and has since risen again, and such that the top 1% share of income by this measure has reached the levels it had in the previous period at the beginning of the century. However, there was a change in the nature of this income that researchers had focused on. So in the early part of the 20th century, capital income, dividends, interest, income accruing to financial wealth was very important at the top. In more recent years, at least to the end of the 20th century, in the 1990s, it looked like wage income, or the income of active earners or laborers, was much more important at the top. So people earning very large salaries were driving top incomes. So there had been this change. Okay. However, if you zoom into the top 1%, so what this does is then we focus on 2014, so take 1 year, and then break the top 10% into different groups. And in the red, we have all the capital income, and in the blue, we have wage income. And what we see is the share of income in those two categories as we move up the income distribution. So if you go all the way up to the top, we actually see the capital income is more important than labor income for those people. And this pattern has been sort of increasing over time, where we see kind of the growth of wage income now in blue circles. I apologize for the inconsistency across graphs. As you can tell, I'm very careful. I try to be. And we've seen that wage income as a contribution to top 1% has been essentially flat since 2000. and most of the rise in the most recent 15, 20 years has come from capital income. So this has raised sort of interest, curiosity into how this pattern has evolved, and the possibility I put at the top of the slide that passive rentier, so these are people who derive their income primarily from financial wealth, kind of the idle rich, famously portrayed in, say, Jane Austen's novels, as Thomas Piketty emphasized. Those folks are now more important again, and sort of the specter of their sort of resurgence is kind of changing debates on inequality, public policy, taxation, and thinking about how the economic pie is growing and how it's sliced between people. Okay, so that's the motivating, let's understand this stuff and see what's going on here. Are the rentiers really back or not? So the first paper I'm going to be drawing on to give you a sense of my approach to this question actually comes from work that I did with 5 colleagues at the U.S. Treasury Department. So I worked previously as an analyst, an intern in the Office of Tax Policy in the U.S. Treasury, so focused on tax policy very specifically and data and measurement. And then with a couple of my research colleagues, Danny Yegan at the University of Berkeley, Owen Zadar, who was formerly at Booth and has now discovered the suburban life in Princeton, is better to his liking. Okay, and so this graph shows what's been a pretty dramatic evolution in the structure of business activity over the last 30 years in the United States. So we divide income that goes to businesses. So this is now not about the top 1%. This is all businesses in the United States. And we say how much of the income is in different forms. So C corporations is the bottom group that was the largest group and really the only group of formal business type in 1980. For tax reasons, this was a preferred form, but the 86 tax reform, which essentially brought top individual tax rates down below the corporate rate for the first time in like 40 years, changed that. And what we've seen is a rise of activity, a migration of activity towards what are called pass-through businesses. These are the red partnerships and the blue S corporations. These are flow-through entities where instead of being taxed at the business level, the money flows through and ends up being taxed at the individual level. So the tax rate that's relevant is the individual tax rate as opposed to the corporate rate. Because the tax reform of '86 changed the relative tax rate on these types of income, business migrated into this pass-through form such that it was as large as the traditional C corporation form in the middle of the 2010s. And the most recent tax reform, which sort of this research I think helps inform, has even amplified some of the benefits, although it also reduced the rate for C corporations. So there's some interesting changes. So it's a very relevant for current tax policy debate, seeing how the reform in 2017 plays out. Okay, why is this important? So we've seen these different tax rates. This just shows why there's been this migration. So for C corporations, the all-in rate, which includes the entity rate and the payout tax rate, was 31.6% in 2011. For S corps, it was 25. For partnerships, it was down to 16 because partnerships get a lot of different types of income. And then unincorporated businesses, which we call sole proprietorships, have the lowest rate, primarily because they're very low levels of income earned by most sole proprietors. Okay, but because of this difference in rates, what type of business you form when you're going to become an entrepreneur or form a business changes because you can receive more after tax if you're in the tax preferred form. What's interesting, and one of the sort of first facts that pointed us towards inequality being an interesting thing to study with this data, is if you look at participation all along the income distribution, these different forms, you see that pass-through income is exceptionally concentrated at the very top. So this particular type of income is the most concentrated. So here we show participation rates. So this is like, do you receive income in this form along the income distribution? In the red squares is C corporation income. So that's like dividends from owning stock. Public stock would be included there. And we see that there's much more participation at the top of the income distribution, but even the top sort of half is getting some of this sort of C corporation traditional income. But then in the yellow, that's the partnership income, and then the green diamonds, or green triangles, that's the S corporation income. It's almost only the people at the very top of the income distribution are participating. So this growth in pass-through income that I showed here really is like differentially affecting incomes or showing up at the very top of the income distribution. If you look at the income shares by percentile, it's even more dramatic, where essentially no one except for folks at the very top, 70% of the dollars in 2011 accrued to people in the top 1% of the income distribution in the pass-through form. Okay? So that fact, combined with sort of the fact I showed about the rise of capital income, has sort of I've now introduced some alternative answers for what's going on in recent years in the rise of capital income. We're going to dig into pass-through to try and understand that. But here I've got some colorful quotes to try and put up a couple stories that I think display kind of the range of potential explanations. So the rentier capital view emphasizes what I'll call the passive returns to accumulated financial wealth. This view, I think, has been most sort of prominently articulated by Thomas Piketty in his 2014 book, Capital in the 21st Century, which our paper is a riff on. And here's a quote that I think sort of typifies his view. The human capital hypothesis is far less consequential than one might imagine. There is little evidence the labor share of national income has increased significantly in a very long time. Non-human capital seems almost as indispensable in the 21st century as it was in the 18th or 19th, and there's no reason why it may not become even more so. So this is a view that really says it's accumulated stocks of financial wealth, idle wealth, and land generating the incomes at the top, this growth of capital income, this important role for capital income at the top is passive returns to accumulated financial wealth. The alternative view, which I'll call the working rich or capitalist view, so I call it the capitalist view because it's essentially putting people back into the idea of capital income, emphasizes instead the active returns to labor, human capital, potentially embodied in entrepreneurs or people who own and operate businesses. A couple quotes here, one from another French observer of the American economy, Alexis de Tocqueville, who, when visiting the United States in the mid-19th century, wrote, "But what strikes me most in the United States is not the extraordinary greatness of some industrial enterprises. It is the innumerable multitude of small enterprises." And I think that quote actually does a nice job of summarizing the findings of the research that I'm now going to dig more into. And then to give a different sense of this view, this is from Alfred Marshall, one of the founders of modern economics, 1890. For a rich client whose reputation or fortune or both are at stake, will scarcely count any price too high to secure the services of the best man or woman he can get. And is this again that enables jockeys and painters and musicians of exceptional ability to get very high prices? So the view here is that there's kind of an increased demand for skilled services. It's showing up in entrepreneurial form. It looks like capital income, but it's actually representing kind of returns to labor or human capital. And these are contrasting views that we're going to use the data to try and separate. Okay, and that's the main paper that I want to talk about today, called Capitalism in the 21st Century. It's joint with Matthew Smith, who's another staff economist at the Treasury Department in the Office of Tax Policy, and again with Danny and Owen. Okay, and so building on this finding from our first paper, looking at the growth of pass-throughs, this graph shows for the top 1%, we took this capital income series that I showed at the beginning that had been going up a lot recently and decomposed it into contributions from business income from private pass-through firms, so that's in green circles, other capital income, interest, rents, royalties, estates, and trusts, so kind of the really passive income that Piketty's very focused on, that's the hollow triangles, and then C corporation, traditional C corporation dividends, that's the green diamonds at the bottom. We see is that the growth in capital income since 1990 or post-86 has really been driven by a secular rise in pass-through income. So this pass-through stuff, these businesses that are not the traditional C corporations that are traded on the stock exchange, that are on CNBC being talked about, but are private businesses potentially closely held, are really driving income growth in the form of capital at the top of the income distribution. Then the question to ask, so we know that, okay, that's where the income is. What is its nature? Is it labor? Is it capital? What are the people doing to earn that income? How did they get to where they are? So that's what we do in this paper. Take this fact, ask what is the nature of this business income, private business income, and why is it rising? we're going to be using microdata that links the population of pass-through firms, that's 15 million firms, to their owners and workers. So we're not just going to be looking at top-level macroeconomic statistics, but really granular data analysis, looking at firms since as pass-through has become more important, and then using this link to owners and workers, which we developed in our previous paper, to really characterize the nature of the income. Being able to link the owners to the firms allows you to say, oh, this is a person who's at this point of the income distribution. This firm that they own has all these characteristics. They're located in this place, they're in this industry, they're this size, they've been around this long. So you learn a lot more about the nature of the income than that it's in some coarse bucket, which we call capital. And that's really the innovation of the line of research that I've been pursuing with these co-authors and using this data. I should mention that we don't know the identities of the people. We just have rough characteristics, so it is anonymized, de-identified data. There's a felony for disclosure, so there's a very strict rules, so everyone's protected and safe, and we work in network remote environments based out of the United States Treasury, so hopefully there's no worries there. There's a lot of security involved in this process, yes. So we're careful stewards of sensitive data. Okay. The paper is going to do two things. Provide a set of stylized facts, which I think of as kind of like informed economic journalism, but it's really like simple facts. This is not something that you necessarily need a PhD to understand. So I think these are just really, really interesting facts. And then we're going to test a couple predictions of what I call the rentier capital hypothesis. The first is that if the owners are just passively benefiting from the firms and just from firm ownership, the performance of the firm shouldn't really depend on their identity. So we're going to be using some experiments, natural experiments, to try and identify and test that hypothesis. And the second is that differences in income across people is just going to be about the size of the firms or that they own very large firms and not necessarily about how well those firms perform. Sort of any heterogeneity or differences across people in terms of how firms perform is going to be evidence that it's something about those people and not just that they've accumulated large estates that's driving the income. So this is sort of the two types of questions we're going to answer more specifically. The conclusion, we're going to say most top earners better resemble what we'll call the working rich, and this income, even if it's called capital, more closely resembles labor or human capital income. And then we can talk about, I think in the Q&A, I'm sure there'll be a lot of conversation about whether it's necessarily, so if it's not passive capital, that doesn't necessarily mean that it's the right return or the socially optimal return to that labor income. It just changes how we think about what it is and problems, policy implications, how should we tax it, all those things. But the results, even if these people are working, could be consistent with what we'll call rent-seeking or lobbying, sort of people earning outsized returns for various reasons. It's just that they have to be working in order to get them, is what it looks like. Okay. I've introduced to you the basic idea of the data, so just a few more facts here. I talked about what a pass-through is. It's taxed not at the entity level, but at the owner level, so the stuff flows through. This S-corporation form is somewhat unique in that you have to have, you can only have 100 U.S. individual owners. You can't have non-individuals as owners, so like corporations, foreigners, et cetera, are not able to be owners of S-corporations. This form is relatively simple, which is why it was introduced. It's now tax preferred. And as a result, since the 86 reform, as firms exited and new firms entered and firms switched, there were actually more S corporations than C corporations in the United States, even among firms that had more than $500 million in receipts. So even among very large firms, it's just that all public companies, so think Apple, think Exxon, are C corporations because the IRS treats them as such once they list their shares publicly. So you can think of these can be firms that are small, like restaurants. If you walk, down Main Street, all those businesses are probably pass-throughs, structured as pass-throughs. They get limited liability, but they have very simple ownership structure. And then there are also very large firms that are structured this way as well, just not the publics. Okay. What's nice about this form is it allows us to, as I say, link the owners who get information returns. These are called K-1s. When they file their individual taxes, they have to document that information, similar to like a wage earner who gets a W-2. It's like an income form for that type of income. But the K-1 allows you to link back to the firm and understand and see all the characteristics associated with that firm when the firm files its tax return. Okay? Our final data set, as I said, had 15 million firms, 26 million owners, and 285 million firm owner years. We focus on the time period from 2001 to 2014 in a lot of our analysis, because that's when this population level owner firm link is available. Okay, basic facts. First is this participation fact, which I showed previously with a little bit more detail. If we look at the top 1% in terms of taxpayers and ask what share of these people derive some income from pass-through business, in the top 1%, it's 57%. That's 947,000 people who collectively earn $474 billion of income. This is in 2014. In the top 0.1%, that's 4 out of 5, or 79% of people. It's 130,000 people who collectively earn $264 billion of pass-through income. What do those numbers mean? Well, there's a lot of debate about sort of executive pay, CEOs of public companies, and it's skyrocketing relative to the workers at those companies. If we look at how many there are, you can take the S&P 1500, those are the 1,500 largest firms on the listed stock exchange. You can take all the top executives that they disclose the income of. It's about 9,900 people in 2014, with 10,000 executives. Add up all their compensations, $32 billion. So this is a way of saying that this private world of pass-through business, closely held business, is just much bigger as a share of the economic pie and as kind of a share of top income inequality. So we talk a lot about CEOs in the press because that information's public and they're on TV talking about their firms. But if you want to understand top income inequality, it's actually more important quantitatively to understand sort of the growth of this private firm activity. So this graph digs into a little bit about what's going on with the types of people. So what do? We take top earners, divide them into age buckets, so 20 to 29, 30 to 39, 40 to 49. We separate them into, do they earn the majority of their income from labor, the majority of their income from pass-through business, the majority of their income from other types of capital, the majority of their income from C corporation dividends. And then we plot the age distributions. And this graph, I think, does a really effective job of communicating that these are different types of people. So if you look at the labor income series, that's the blue circles. The most people in the top 1% who earn majority labor income are in the 50 to 59 age bucket. It's kind of like prime earning years you could think of for various professions. People who are doing very well, who built 20 years of tenure in their careers. So that's the largest category, and then 40 to 49 is the second largest. In the retirement years, sort of 70, 79, 80 to 89, et cetera, there are very few people who earn the majority of their income in labor income. That makes sense. That's sort of like a smell check, like kind of, are we looking at the data correctly? Interestingly, the pass-through sector looks very similar to the labor income bucket. So that's the red triangles. The people who earn majority of their income in pass-through form are very slightly older, but very similar. In contrast to people who earn most of their income from other capital, so I would call the Piketty category, there are a lot more people who are 70s, 80s, kind of people who have accumulated a bunch of wealth over their life cycle, who are earning the sort of income that flows to that wealth, but not necessarily working anymore. So the octogenarians, the rentiers, the folks in Jane Austen's novels are not really the pass-through earners, at least in this way of looking at it. But traditional C corporation dividends and other types of capital really does look like it's more likely to be in the passive nature. The paper has a whole ton of extra facts, and I've summarized them on a bit of a text-heavy slide, which I apologize for, but this fact-finding mission sort of delivers a lot of interesting facts, and I've highlighted a few. The first I've showed this working age fact. It's also the case that if you look at top pass-through owners, their income is quite undiversified in the sense that they typically earn most of their income from one firm. So it's not like a portfolio of a bunch of firms scattered all over the place. It's really a concentrated source of firm. They often have considerable wage income. When asked whether they participate more than 500 hours in their business, overwhelmingly pass-through owners report that. So all of these facts point together towards someone who's kind of actively involved in that one business, and that's generating the income that we see. If we look at the firms instead, these are what we call mid-market in size as opposed to being superstar, very large firms. So 65% of top sales are in firms that make less than $50 million in sales. So these are firms that are much smaller than the firms that are listed on the public stock exchange. Almost all of the dollars are earned in firms that make less than $500 million in sales. So actually, if you look at kind of the distribution of firms, like where are the big firms? They're almost all traditional C Corps, publicly listed. Where are the small firms? They're in these mid-market and larger categories. There are a few exceptions, publicly known. Exceptions like Cargill, I think, and the Mars Corporation, Fidelity Investments are large pass-throughs. Menards, actually. But largely speaking, sort of you pick a firm out of the hat, they're small firms. They tend to have a very small number of owners, too. So they're closely held, 2 or 3 owners at most, not many owners with maybe one manager. So it's more likely that these are also managers as well as owners. If we look at the industrial composition, and I'll show a little bit more on that, their S corporations are quite diverse. There's representation across all sectors of the economy. It's not just finance. It's not just Silicon Valley tech. And there's less physical capital intensity in that sector. So they tend to skew more towards skill-intensive service sectors. That'll become very clear in a slide. In contrast, traditional C Corps, very capital-intensive, like energy, telecom, manufacturing. So sort of different chunks of the economy are organized in these different forms because of their dependence on different factors of production, so capital versus labor. If we look at partnerships, very skill-intensive. Folks might not be surprised. There are a lot of lawyers, a lot of folks in the financial services sector, so hedge funds, private equity, venture capital, then also a lot of consultants, accountants, health services. But here's a fun table. We have a couple tables like this in the paper that really granularly show what industries top 1 to 0.1, top 0.1 earners are generating a lot of their income in. So we just take firms that have these top owners and say, what is aggregate all the profits of those firms into categories. Okay, and so this is for this graph is for S corporations. And in the top 1 to 0.1, the largest category in very narrowly defined industries is offices of physicians, followed by other professional and technical services, which is another consulting kind of category, followed by dentists, followed by specialty trade contractors. So these are folks that work in kind of real estate and construction adjacent fields, like people who are like roofers, tilers, plumbers, that kind of stuff. Legal services or lawyers are number 5. Architects, we have restaurants. These are not capital intensive. These are skilled services for the most part. Although there is representation kind of across the firm side, the industry distribution. So you have wholesalers. There's just not that much manufacturing is the one exception. If we go into the top 0.1, so these are people who had a flow of income greater than $1.5 million in 2014. The largest category is actually a management of holding companies. These are companies that own companies that are in different industries. It's a little hard to know exactly what industry they are. The second, other financial investment activities, where financial services like private equity, venture capital, hedge funds would be. The third is auto dealers, which it was an interesting fact that really jumped out. And actually, through the tax reform debate, I learned that there were 3 auto dealers in the House Ways and Means Committee, which is the committee within the House that writes tax policy. So if you run a successful auto dealership, there are a lot of folks in the top 0.1% there. Fourth is professional technical services. Fifth is oil and gas extraction, so think fracking and that kind of stuff. Sixth is doctors. So you sort of see still a lot of services, but a little bit more capital intensity, a little bit more of a role for passive stuff as you move further and further up into the tails. Nevertheless, I think the conclusion here is that this is still quite diverse activity. It tends to be more skill intensive. It's also geographically diverse. So it's not just in New York and Silicon Valley. It's like kind of everywhere else in flyover country. There are, folks in these categories who are, doing quite well from the businesses that they own. Okay, and then this fact just kind of summarizes that by correlating different measures at the industry level of either labor or physical capital intensity. We see industries where a large share of the workers have college degrees, where the average wages are high among firms in those industries, where the share of workers using computer is high. These are industries that tend to have a lot of this top pass-through income. In contrast, industries where there's a lot of capital per worker that use a lot of research and development expenditure that are very concentrated in their structure are not where a lot of the pass-through activity is. Knowing that there are a lot of sort of doctors and service providers, you kind of understand that this is not the same story as, say, the superstar firms like Amazon and Walmart and Google that are driving other patterns in the economy, but not necessarily driving top income inequality in this way. Okay, so then I talked about how we would, after doing some journalism, look at some more direct predictions, hypotheses of the Rentier story. One is that the owner has no role in the firm's operation. And the way we figured out how to study this question is to identify a sample of top pass-through owners who prematurely died, which is somewhat morbid, but nevertheless a very useful natural experiment to study this question of whether they're playing a role in the firm's operation. So what we do is we identify several thousand premature deaths are defined as people who die before the age of 65 or 70, and study what happens to the firm around that event, comparing them to firms that look exactly the same in terms of industry, size, ownership composition, but who don't have an owner that prematurely dies. And so a prediction of this passive view is that there would be essentially no effect or a very small effect on firms, and that's not what we find. On the left, we look at the probability the firm survives following the owner death. Immediately after the owner death, the firm has a 20 percentage point decline in its probability of survival. And we've tried to look to see whether these firms are sold, whether the workers just kind of reorganize. For the most part, that's not the case. So these are firms that just stop operating when the owner dies. If we look instead at how profitability changes, this is a fall in profits per pre-period worker of around $10,000 per worker, or $10,000 to $15,000. Quantitatively, that's an effect of about 50 to 60% of firm profits or firm profitability or scale. So the interpretation is that of the amount of profits that these pass-through firms are reporting, 2/3 of it, or 60% of it, looks like it's labor or human capital of those owner-managers, as opposed to just passive capital that will be earned subsequently. A second test that we run is to look instead at whether firms are kind of operating similarly and just different in scale. So are people at the top very rich just because they have much bigger firms, but they're generally kind of performing similarly to the small ones? Or are they instead performing differently? So what does this graph do? So we take people in the top 10%. We look at the profitability of their firms, so profits per worker of their firms on average, up the income distribution. Okay? And we look at firms where we just compare them, potentially apples to oranges to very different types of firms because top people might be in different industries. And then we look within industry, we look at firms that are similar in size and industry, and we ask, are they performing similarly? And the answer is no. Actually, firms at the top appear to be about twice as profitable per worker as firms at the bottom. The story, this is suggestive evidence of sort of a role for owners because if it were just passive capital that they were providing, there would be less difference in kind of the rate of return they earn. So it's sort of like investing in the stock market. You might get a little bit more, but you're not going to be twice as good because capital markets are relatively sort of effective at sort of prices moving around. But if instead this profitability is about differences in wages or about sort of different, you can kind of think this looks more like kind of what the wage distribution looks like as you go up the income distribution. So it's sort of like people at the top earn higher wages. This is kind of a pattern that looks more like that. There's a concern this might be a little mechanical. So the thing we do is we look at startups or new firms that are founded by people who prior to starting the firm were in sort of the top of the income distribution. They tend to perform better in the subsequent years than firms owned by people who started out a little bit lower in the income distribution. This profitability advantage has been going up over time and is contributing more than differences in firm scale to the growth in sort of income in this form at the top. So these firms are not necessarily getting much larger. They seem to be just getting more and more profitable. And like the example, if you wanted to take like the doctor-dentist example, the doctor's fee or the prices charged for services provided have grown a lot faster than the size of those doctors' offices. I'll skip the risk thing. Talk about tax policy a little bit. So one of the things that we are interested in as tax analysts is that tax policy really does seem to affect the organization, the structure of business activity. It seems to affect how people report their income. And this actually can have implications for economic measurement, for these basic facts like we were talking about top income inequality, what's going on. Well, as the tax code changes, it changes what we measure. Because what we measure changes, then it's hard to interpret some of the time series patterns as just reflecting like real changes as opposed to these tax-induced labeling changes. So we try and quantify some of that stuff. What we find is that a large share of the growth in business income, this pass-through form, is coming from firms switching from traditional corporations into these pass-through forms. But most of it is real growth. So there's 25 to 30% is due to these corporate form changes. We have different ways of measuring that. 70 to 75% appears to be real growth. However, because there is a large share of this sort of relabeling activity induced by the tax code, you can ask questions like, what's going on with labor share of income at the aggregate, and how has tax policy affected that? So what do we do here to try and measure it? We look at firms that switch from C corporation to S corporation form and ask what happens to labor payments and what happens to capital payments around the switch. So once they become an S corporation, now there's an incentive because they can avoid the payroll tax on their labor income to declare what was previously labor income as profits. And we do see around these switching events, this is using several 100,000 switching events, that labor compensation falls as a share of sales and profits rise. There's also a lot of cool heterogeneity, which I guess I'd cut. If you look at doctors and dentists, it's like 6 or 7% of sales, like a mirror image split. So they were previously paying themselves labor income. It all becomes profits after they switch, which is strong evidence of this disguised wage income being present. We then used that estimate to try and ask how much has, say, the labor share of income in the macroeconomy. Potentially it's understated because it used to be that this was labor income. Now it's showing up as profits. And the answer is like about 20 percentage points, 20% of the decline in the labor share, which has been another thing that economists and folks, I think also in the popular press and policymakers have been really concerned about, is actually due to tax-induced relabeling, kind of preferring a certain kind of income that's very flexible. It can be entrepreneurial. It has a mix of capital and labor, but depending on what tax rate it faces, sort of the income morphs or changes forms. So that, I think, is relevant for policymakers as well as for people who are just basically looking at macroeconomic statistics, trying to understand what's going on in the economy. What's the role of outsourcing? What's the role of automation in sort of the decline of labor share? Well, some of the decline in labor share is actually just tax-induced relabeling of labor income, which is, I think, a pretty different story. So understanding the relative importance of these different factors is not something we're going after in this paper, but it points towards a more serious treatment of kind of how the rules of the game, the intricacies of the tax code which I had an advisor in grad school called The Intersection of Boring and Boring when my thesis, what I was working on, it turns out to be kind of important. And as a highlight of work future to come, the big question that our paper does not answer is sort of where are these people coming from? It's sort of an analysis of where they are, kind of a point in time, and what's going on at the top. But I think the natural next question is to ask what are the backgrounds? Is there equal opportunity to enter this kind of stratosphere to become an entrepreneur or a business owner and enter the top 1%? And I have one provocative graph on preliminary research here, where we look at people, the share of founders. So these are people who go to start pass-through businesses. Under 40, we've been able to link them to their parents using data from the Equality of Opportunity Project based out of Stanford. And what we see is that there's a much higher propensity at the very top of the income distribution to become a founder, to become an entrepreneur, which is not that surprising. And there's interesting also variation across characteristics. So the propensity is much higher for men than women. It's an interesting question to understand what's going on there. We're looking at professions, industries, et cetera, but trying to understand kind of is there equal opportunity? Is this income kind of fairly earned? These are questions that people want to know the answer to. So facts that point towards that is I think, the goal for ongoing research. But thank you very much for your patience and time. I look forward to questions and coffee and all that other good stuff.
Great program. I wasn't looking forward to this thing, and I really liked it. I also thank you for putting on all your graphs, little triangles and open things. If you're colorblind, it's a gift.
Oh, yeah.
It is truly a gift.
You're welcome.
So I was involved for 25 years in a family business, very successful. We did maybe $100 million a year. And in preparation for the owner's retirement, we shifted to an ESOP, an employee stock option plan, predicting that once the employees owned the company, its success would continue. It closed within 2 years. And I'm curious if you've done any research on shifting that kind of ownership.
Yeah, so I'm actually actively involved in a revision of this paper, and you have this referee process where the referees complain a lot, and then you have to make them happy by doing all the stuff they ask for. Yeah, exactly. It makes the paper better, but you get to occasionally grumble. So one of the things that we've done that is actually we've augmented the owner death analysis with what we call an owner retirement analysis, where we look at a scenario in which the firms transition from having an owner who receives also wage income from the firm to having no owners that receive wage income from the firm. So we identified a bunch of owner retirements, find very similar effects, which I think speaks to your sort of instinct, which is that those owners were kind of specially, I don't know, the special is like but they were, for that business's operation, really critical. And they were doing stuff. A lot of what made that firm successful was, in fact, what those owners were doing while they were working there. That's not to say it can't be the case that like when employees take over, but you need that same kind of sort of management, ownership, whatever's going on there seems to be kind of unique for the firm's success in a lot of cases. So happy to. I love anecdotes, as Anil said. So, what was the industry? Construction. All right. So that was 2389. That was our specialty trade contractor potentially.
Hey, Eric, thanks for a great talk. I'm to your left also. I may be really misfiling something in my head, but I feel like one of the takeaways I have is that my sort of market matching investments at Fidelity or wherever, sort of stock market based kind of portfolio is ever and ever less reflective of the economy as a whole. Like I took the C Corp, I'm investing in some portfolio of C Corps, right? Through those things, through my 401k and whatever. And I'm kind of flashing on, not on Jane Austen, but on Downton Abbey. And his concern of, if I change what I'm doing, how does that affect my tenants? I've lived here, I've been a steward of this resource, I've had these people living on my property. I feel like I'm the investor in the enterprise of capitalism, and yet now a smaller and smaller piece of that is available to me while these guys have these privately held things that I no longer can invest in. Can we connect the dots on like the notion of how does it affect at a macro level the investment opportunities of the not owners of anything?
Yeah. Well, I mean, so say if at the macro level, the sort of share of income that's like goes to human capital is like increasing a lot, then it's just what you are doing when you invest in those companies, you're kind of providing them with financial capital. And that's just a less needed factor in certain sectors. I mean, legal services, it's sort of like there will be maybe some very large publicly listed sort of legal services, but relatively few. We have seen in some cases, like Blackstone is a financial manager that has actually listed a share of its general partner, which is like actually listing a share of the firm as kind of the human capital providing firm, which is managing all the investments, and sharing that with stockholders. It's still like the exception. I think it's a very interesting question, but it's true. The stock market, if you look at, it's a one chunk of the economy that's very capital intensive, a lot of manufacturing, and very little services there. So when you invest, you're not getting exposure, which is what the finance term is, to that chunk of the economy. When you invest in human capital, by getting education or by making sure your kids get education, all that stuff, you are in some sense giving them exposure to that chunk of the economy, but it's not diversified in the same way. So it's changing the structure of the economy. The importance of sort of human capital and education is increasing, I think. It's one way to interpret it.
Hey, thanks so much for your talk, Eric. I was wondering, so this new paper you're doing, The Origin of Entrepreneurs, is part of the interest in that potentially the idea of an evolution of essentially like a lineage of funds or money? Because from what you were suggesting with that one graph, it sounds like that individuals who have essentially a parent or guardian who are able to invest in their idea are the ones that are able to invest in a new business, other than like say somebody who's starting from the ground floor without that inherited investment. Is that something that's probably going to be more explained in that paper?
I hope so. I mean, I think so that because we're so early, we're basically in fact collection at this point. But some of the big questions that I think everyone wants to know the answer to is like the relative importance, say, of self-made versus inherited wealth for subsequent success. And one path to success, I mean, you can think about one version of the American dream is to start a business and be successful, be able to do that. That's certainly one picture of it. Is that equally available? What are the factors that are most important? So parental background is one, geographic exposure is another, like industry exposure is another. We're going to try and look at schools like colleges and that kind of stuff, and try and separate some of these like exposure factors from what I would call like financial availability, like of parental wealth or income. This is kind of to support people when they do go on these risky ventures. You need to have kind of some savings or access to savings to take that risk, to try and understand that as well. So we're really, at this stage in a project, you can be like super ambitious and bold, like let's go after all these big things, and then you shrink the thing to like here's what we can actually say. But when I only have one slide, I can be ambitious. So that's the direction we're going. Let's see how far we get.
Hi, Eric. Thank you so much. I'm also an economist from the University of Chicago, and I'm very impressed by your work. I think there is very little information about the top 1%. Your work is very enlightening in that respect. But a couple of questions. From a policymaking perspective, what really motivated this change in the laws to create this kind of loophole for partnership? What was the motivation from the government? Mm-hmm. And the other, you can change in the perspective and the story of Piketty that the wealth of the top 1% is based on inheritance. but you're saying it's mostly about specific skills. Now the open question is, are those relevant skills that we need in the economy to promote economic growth, and should make sense to lower taxes on those particular individuals or no? So that's the question.
Yeah, so those are, so the first question is, what was the motivation? I mean, the tax reform, I would think of this as maybe an unintended but not surprising consequence of the tax reform of '86. It was really meant to be a simplifying reform. This was a time when there had been a ton of loopholes opened, and there was a lot of concern about distortions in the tax code. Like, we kind of want it to be as, kind of, it's like we have to raise a certain amount of revenue to buy the things as a society we've chosen we want to buy. And how do we do that as efficiently as possible, and then also achieve some amount of redistribution, because that's a policy priority as well, the progressivity. And there was the view that the tax code leading into '86 was failing both those dimensions, and it was creating lots of distortions, what kind of activity people were doing, how they were hiding their income, sheltering. Bill Bradley, who's a basketball player, was paying much higher taxes than certain real estate developers, that kind of a thing was motivating the reform. So it really was like a simplifying reform, created this unanticipated effect, which was to change the structure of business so that there were more of these pass-throughs around, and those rules have been lobbied and weakened and made more generous over time, and we're probably due. We've had a big tax change, but we might be due another reform in the next 4 or 5 years. I would predict, to try and equilibrate some of the distortions that have been introduced as I see them probably. But we'll see what happens. Kind of, there's a bit of like, let's do some policy evaluation of these different changes that have just taken place to try and understand how big the new distortions are and trade those off against some of the purported benefits. That's TBD. Your second question was about, it's not sort of financial inherited wealth, but skills or something, and are those the right ones or not? I mean, one view of it is like, okay, here I showed you all the different professions or industries where like folks are doing extremely well, and we can ask, comparing across countries or, over time, is it the case that they're paid kind of the social return, or are there distortions in those markets? So to give an example, there's a lot of concern about occupational licensing and the growth of occupational licensing restrictions in different professions, which have essentially created barriers to entry. Good examples like realtors, but there are other examples. Doctors you think of as having a lot of restrictions on who can become doctors, or like the number of new doctors each year. That has the effect of restricting supply relative to maybe what we would see enter. So those kinds of restrictions. And then there's also, are we producing enough people who have like the skills, education, reading, writing, computer skills to enter those professions? We've probably underinvested in education the last 20, 30 years, sort of from a public society perspective. And so, if it's not physical, financial capital, but is instead human capital, and the prices are saying we don't have enough of this stuff, then we should buy some more, I guess, or increase access and that kind of thing. So that's how I'm thinking about it, but I think big important questions.
A lot of the things that you presented were, I think, a little over my head. It was complicated. One of the things that surprised me, and in a good way, is you in your previous answer, you just touched on that, is that people who, the human capital is so important. Yeah. So, parents want their children to be either doctors or lawyers. That seems to be a good way to, to have a profitable career. And I guess I didn't realize it. And actually, to me, this indicates of a level playing field. Yes, you need educated parents most of the time to, to send their children to college. But also, I am a first-generation immigrant. And a lot of the first-generation immigrants, they go to college. They're the ones that become doctors. They're the ones who become lawyers. Mm-hmm. And the question is, the picture that I have in my head, does that reflect the reality? Is this the way to achieve, I guess, successful life? Rather than buy a restaurant, do you want to be a doctor?
Yeah, I mean, so I think you interpreted the data, I think, correctly in the sense that what I present is consistent, I think, with a lot of your impressions. Now, there's a question like, what does the future look like relative to the present? And it could be different, but I'm more optimistic about the role of human capital in the next generation than most of what Piketty's book sort of, as an example, emphasizes. Instead, that you have to be born to like extreme wealth to have any chance to have high income in the future. I just feel like that's a story that's provocative, but is probably oversold relative to the facts. You pick a person, and the top 1%, maybe Piketty doesn't care about them because they're only making $500,000 a year. It sounds like a lot of money to me. That's like if your kid ends up being that successful, like that's a win, right? I don't so maybe like we spent a lot of time focused on like Zuckerberg and Sheldon Adelson and the super wealthy, but there's a much bigger world of people. It's 1 million people up there who are doing this stuff. So yeah, I think it is a bit more optimistic than the current political debate about this stuff. I agree. Yeah. Not Panglossian, I hope. There's still room to make it better. It's not the best of all possible worlds. I won't say that.
Hi, thank you for a really interesting talk. You both showed a plot showing that there is an effect of people who are working or owning companies on how profitable the company is, but you also showed that effect is concentrated at the top performing companies, that most companies don't have as large of an effect. How concentrated can that effect be before we start to say that, generally speaking, they don't have that much of an effect?
Yeah, I see. Yeah, well, I mean, so there's a lot of activity. So there's kind of two ways to answer the question. There's like a firm or dollar or person level analysis, like treat all firms equally, even the much bigger ones or smaller ones. And then there's like for aggregate incomes, how important is the fact that in the very top, because there's so much income at the top, the fact that those firms are quite profitable, and it's not just at the very, 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 very top, but like there is a bit of a gradient. It's like a really interesting finding that honestly I still don't know the total answer to. Is it technology? Is it barriers to entry? Is it just disguised wages? How do I decompose it? So would like to know the answer. And across industries, like why would a top restaurant owner be so much more profitable per worker than a non-top restaurant owner? I guess like the owner of Alinea, there's like something magical in what they're doing there that gets spread out and shows up. That like the owner of sandwich shop doesn't get. Maybe that's what's going on, but like that's kind of, it's a hypothesis, right? And I think it's good to like, I agree, it's like a provocative fact, but like we don't totally understand it yet.
I'm going to ambush you with a question. I'll let you, a couple more people ask, but at the end of the talk, you know a lot about taxes. And lots of people are very confused about taxes. So maybe at the end you can think about what are the 3 things about taxes that you think the general public is unaware of and might benefit from knowing. Run that in the background.
Word. Okay.
Oh, okay. They claim that there's about 4% unemployment, but they don't include people who stop looking for work. And other people may be part-time or contingent workers. So what do you think the real unemployment level is?
So it's a little bit far from my particular field of expertise. There are a bunch of statistics beyond just the unemployment rate, which you say is really just about folks who are actively in the labor market. There's like the employment to population ratio, which is not subject to concerns about they're not counting the people who aren't looking. That's not quite where it was prior to the Great Recession, but it's increased more, I think, even than some academics predicted it would increase. I think the way the labor market has responded to the recession, it's like we're 10 years later and still kind of like adjusting back to it. Although, you know, like it's not really my area of expertise, but I would say there's a lot of good data out there beyond the 4% number that ends up at the front page of the newspaper. So I'd be less worried about the statistics not being correct in the sense, but you know, just like there's a set of statistics that they look at, not just the 4% number. So yeah, there's still people, like you said, looking for work. I believe that.
I guess my question is pretty arbitrary. Why is 1% so important? Why isn't 2 or 3% important or 5% important?
Totally agree.
And also, what is your when you're doing your statistics? What's your plus and minus on the you know, the actual data? You know, like when you get your data, is it within a, you know, plus 3%? You know what I'm saying? Like for accuracy, for accuracy.
Yeah. So I totally agree. Partly is like this has become such a popular political and in the research like literature like kind of a focal point. And so if you want to contribute to a literature, you know, it's easier to make the connection using kind of the object of interest that others have. We do a lot of stuff where we look kind of within the top decile. I think the reason people are interested in the top 1% is because it's such an impressive share of aggregate up there, and there does seem to be a bit of a change in the nature of income, although I showed it was like more gradual, right, like the labor capital share. So there's more overlap up there than that. But I think it's just, you know, marketing, just good branding, right? It's like this is a thing that people just like jumped onto. Bernie loves it. I mean, it's like across the political spectrum, you know, it's just like they're an object. But there's a lot more heterogeneity within that group than I think the Occupy movements talked about, you know. So I think there's a little bit of like, let's understand actually the heterogeneities. That's why I do 1 to 0.1, which we call the top, and then I would call the 0.1 the tippy top. Like I have all these, you know, these like names for these things, and there's a tippy dippy top. And like you're like trying, you know, it's like, okay, let's like really understand the heterogeneity. That's my bottom up thing. Is kind of like there's this monolithic idea that's simplifying the world a lot. The second point is like we're for a lot of these statistics working with population data. So actually the standard error is like there's no sense in which like it's a sample. The variation would come from there's like different parts, like worlds, you know, like different manifestations of this world that we don't see. So I guess it is church day, so they can get like kind of philosophical, but like, you know, but like we don't get to see that, so we don't have data from them, and we actually don't have good ways to build sort of standard errors around those statistics, except to maybe randomly sample and generate stuff. But yeah, I think it's a fun question.
Follow up, my point is, I guess it's like, something about, anyways, it has to do with the 1 to 3%. I don't know. I forgot what's in it.
Yeah. Okay, we can talk about it after. Yeah, cool.
Hi, thank you for a great talk. As a undergrad economics major, that was brought me back to the good old days.
Awesome.
Besides that, I spent 20 years at the Chicago Board of Trade as an independent broker trader and was unable to make the transition from open outcry to electronic trading. Yeah. So I was wondering if you could, if you have looked into any of the impact of, what term am I looking for? Technology impact on the top 1% and 0.5%, how big of a factor that's played into it.
Yeah. Now this goes back a little bit to the question about like, is it safe for me to say you should be a doctor or lawyer or something, right? Like technology is affecting different professions in ways that's hard to predict. But I think the research that does exist on sort of the role of technology and growth and wages is that it tends to evolve in ways that's complementary to like human capital. So but in professions, you can see probably differences, probably sort of people who are able to, you know, like take the new technology and apply it, kind of grow relative to people who are using the old technology. And so there's a lot of churn that's not really necessarily present. You can kind of see it actually when you try and do industry statistics over time. Because like they've had to change the industry codes every decade or so because there are all these new industries that weren't there before. And so you can kind of see like growth is definitely hitting the economy, and then like, you know, some sectors shrink and some grow. So yeah, so like there are probably professions that were really like sort of closer to the top and have fallen some because of the way technology has either caused them to be outsourced or caused them to be much smaller than they otherwise were. Yeah, but we haven't really analyzed that, but I think they're really interesting questions.
One of the big differences between economists and regular people is economists have massive faith in the future turning out okay, largely because we figure people will adapt. But if you take, for instance, 1972, and you look at the classification of what kinds of work people did, more than half of the people now have jobs that weren't defined in 1972. We have 4% unemployment, or whatever the number is. So yeah, that is a thing about economists that make us weird.
That's right. One of them.
Good morning. I wonder if there's any relationship between your work or the shift in the way that income is distributed and wage stagnation, or are those completely separate? I know your data, at least here, is from 2000 to 2014, and wage stagnation goes way back, you know, decades previous to that. But is there a connection at all?
So yeah, I mean, I think the wage stagnation fact is a puzzle that is not fully understood, but it's also, if you think about the distribution, like the median has had a different experience than, say, people near the very top. And it's probably because of kind of what, you know, this human capital or skill bias change. So the median wage is earned by someone who is less reliant on those kinds of skills. They've benefited less from the way growth is tilted in the U.S. And have been hit more by sort of other changes. I mean, the one that comes, you know, to me is like the outsourcing change that's like really hit manufacturing workers hard, where I think they were very important in middle incomes. But like the location of manufacturing labor is like has transformed dramatically, you know, over the last 25, 30 years. So that's where I would start to go to hypothesize, but I think it's an open question. But if you think that like this human capital skill stuff is going on at the top, you know, the story that would be consistent is that, yeah, there's like a sort of there's a wage, and then there's a wage plus skill premium. And, you know, further up in terms of the skill distribution, they're seeing more of the benefits from economic growth. And that's like, you know, that would be one hypothesis.
And this will be our last question.
All right. Thank you for a great talk. I was just curious, this is a little tangential, but the increase in healthcare spending that you see, do you know how much of that is related to profitability of doctors changing?
Awesome. So no, but I have a bunch of health economist colleagues that I keep nagging to like answer this question. Unfortunately, you know, the health costs have gone up in a lot of different, right? There's like pharmaceutical stuff that's quite different. There's, I don't know, like hospitals and what they do. Some of it's paying doctors, but some of it's all the other services they provide. So decomposition like that, super interesting. Also comparing across countries that have very similar health quality and health outcomes, but very different structures for paying. I mean, I think one of the conclusions for specific sectors where you're like, oh, wow, these people are doing very well in these sectors is like, are there barriers to entry or are there weird prices being set by the way we pay for this stuff? Healthcare is certainly an area that I'm not the first person to say maybe we're paying for it in a weird way. And so, and that's like, for that chunk of the economy, what's going on. But I don't know the exact number. And then Anil asked about stuff about the current tax code. Anything about taxes. Oh, there's so much. Well, did you know that taxation is the foundation of like the independence movement in So like taxes are like the birth of the country is founded on people being, griped about taxes. So just keep that in mind. So then, one thing that I think like just really fell out of the tax reform debate that was like should come back in, and I think this research really speaks to, is that we shouldn't treat like the corporate sector and the individual sector of the economy for tax purposes as these separate entities without a bunch of overlap and spillovers. And so when we set tax rates, we shouldn't be like, oh, let's drop this one so we can raise this one and like balance it all out. We need to have a harmonization across different types of forms so that there's less of these distortions, because that's just like not benefiting anyone. And so there's a bit of like, there was an old view of how business was structured that informed a lot of the debate. And they've tried to introduce guardrails to protect some of it, but I don't think it's going to be, hard to enforce. So I think in future tax reform, I'd like harmonization to be a word that people use. So thanks very much.
Thank you.